Welcome to part 4 of our discussion on quiet title actions. If you haven't seen parts 1, 2, and 3, make sure to check the links in the description below. Now let's dig deeper into the topic. In a mortgage transaction involving a promissory note, a receipt is a written acknowledgement that confirms the transfer of value from one party to another. When you sign a promissory note as part of a mortgage agreement, you are promising to repay the borrowed amount under the specified terms. As proof of the transaction, you should receive several key documents. 1. The promissory note. This document outlines your promise to pay back the loan, including the loan amount, interest rate, payment schedule, and other terms. The lender should hold on to the original note. 1. The mortgage or deed of trust. This document secures the promissory note and gives the lender the right to take possession of the property if you fail to repay the loan. 1. The loan payment receipts. These receipts acknowledge the amount paid and the remaining balance. They provide a record of your payments. 1. The proof of funds. Letter. If you make a cash down payment, you may need a POF letter from your financial institution to show available funds. 1. The final mortgage statement. Once the loan is fully paid, you should receive a statement indicating zero principal and interest due, along with the total amount paid. 1. The paid in full letter. This letter from the lender confirms that the loan has been completely paid off. 1. The release of lien or satisfaction of mortgage. This document is issued by the lender once the mortgage is paid off and releases the lien on the property. 1. The canceled promissory. Note, ideally, the lender marks the original note as paid in full and returns it to you. These documents are crucial for future financial dealings, tax purposes, and resolving any disputes. If you don't receive them, reach out to your lender. But here's a thought. In a quiet title action, you, your entity, or your trust can be the plaintiff, and the property address is the defendant. This understanding is key. It can help you navigate the process efficiently. Additionally, you can obtain a securitization audit that traces the paper trail of your mortgage from closing to the trust, along with a Bloomberg financial report. These documents provide admissible evidence in court, showing that the note was paid off when the insurance or credit default swap was triggered. Remember, if the note was paid off, nobody is damaged. The logical claim to the house would be by the insurance company that paid out the claim. To summarize, in a quiet title action, you, your entity, or your trust are the plaintiff, and the property address is the defendant. This understanding is your golden key. Thanks for joining us for this crucial discussion on quiet title actions. If you found this information helpful, be sure to like, share, and comment. And don't forget to subscribe for part 5 of our discussion.